Welcome to The Explainer. Today, we are running what I like to call the ultimate investment test. We're taking a real, publicly traded company and forcing it through the guru gauntlet. We're going to strip away all the daily market noise and analyze this company through the incredibly distinct, rigorous frameworks of three legendary investors: Warren Buffett, Peter Lynch, and Benjamin Graham. And then, just to bring things into the modern era, we'll run a discounted cash flow analysis on it too. Okay, let's dive right into this. The stock on our dissection table today is Worthington Enterprises, ticker symbol WOR. By running it through these dramatically different investment philosophies, we are trying to answer one deceptively simple question. Is Worthington Enterprises a buy right now? So here is our roadmap for the gauntlet. First, a quick company snapshot and financials. Then, we apply the Warren Buffett, Peter Lynch, and Benjamin Graham lenses. After that, we'll look at the DCF and alternative models, and finally, we'll wrap it all up with a synthesis and our final verdict. All right, Section 1, Company Snapshot and Financials. So Worthington Enterprises, what do they actually do? Well, they are a designer and manufacturer of market-leading building and consumer products. We're talking HVAC components, metal roofing, outdoor living tools, and those propane cylinders you see everywhere. At the time of this analysis, their stock is trading at $59.68. They offer a pretty modest dividend yield of 1.27%, but you really have to look at that return on equity, an absolutely massive 22.53%, right alongside a solid return on assets of 12.38%. They are clearly generating a very efficient return on shareholder capital. But how are they growing? Well, they aren't just sitting back relying on organic sales. They are aggressively acquiring other businesses to grow. They bought Hexagon Ragasco in 2024, Elgin Manufacturing in 2025, and most recently, LSI Group in January 2026 for approximately $205 million. They are specifically targeting asset-light, high-margin, market-leading niche brands. Keep that phrase asset-light in your back pocket, by the way. It's going to be super important when we get to Benjamin Graham. Moving on to Section 2, the Warren Buffett lens. What's really interesting here is how we have to weigh Buffett's criteria against the company's current reality. You know Buffett loves a high return on equity because it shows management is compounding capital efficiently, right? And Worthington's 22.53% ROE definitely passes that test. Their moat comes from completely dominating very specific niche markets, like commercial metal roof clips and composite cylinders. However, we have to balance that against the risks. Their end markets in construction and consumer goods are inherently cyclical. Plus, they're carrying $312 million in total debt. Now, while that debt did increase recently to fund their acquisitions, they still have massive liquidity. So Buffett wouldn't necessarily be scared away, but he'd for sure keep a very close eye on it. For Buffett, the absolute most crucial point is cash, real, tangible cash. He famously uses a metric called owner earnings. We've extracted the exact numbers from Worthington's recent 9-month consolidated statement of cash flows to figure this out. We take their net earnings of $106.9 million, add back the non-cash depreciation and amortization of $41.4 million, and then subtract their capital expenditures, which is what they spent on property, plant, and equipment, which was $39.4 million. The result? $108.9 million in real owner earnings over just 9 months. This proves the company generates highly consistent, real cash flow well above their reported net income. Buffett absolutely loves this. But what is the localized verdict from the Oracle of Omaha? Well, even though Worthington has delivered 6 consecutive quarters of adjusted earnings growth, Buffett famously insists on a margin of safety, usually around 20% below intrinsic value. At roughly $60 a share, Worthington is priced for perfection. So for Buffett, this is a hold. It's a wonderful company, sure, but he would likely wait for a cyclical dip down to around $48 before backing up the truck. All right, Section 3, the Peter Lynch lens. To really understand Peter Lynch, you have to understand the PEG ratio. The PEG ratio is calculated by taking the standard price-to-earnings ratio and dividing it by the annual earnings growth rate. It essentially links current valuation directly to future growth. For Lynch, a PEG ratio right around 1.0 means the stock is fairly valued. Anything under 1.0, that's a potential bargain. So what is Worthington's PG ratio? It's 1.08. We calculated this by taking their current PE ratio, which sits at roughly 26.17, and dividing it by their aggressively forecasted earnings growth rate of 24.22%. A PEG of 1.08 is incredibly close to that magical 1.0 threshold. This suggests that despite a seemingly high PE ratio in the mid-20s, the price is actually quite reasonable if they can hit those projected growth targets. Running through the rest of the Lynch checklist gives us some massive green flags. Lynch would likely categorize Worthington as a stalwart that's exhibiting fast grower tendencies, mostly thanks to their M&A strategy. Furthermore, Lynch absolutely loves a strong balance sheet, and Worthington has over $495 million in available liquidity. And crucially, management is actively buying back shares. They repurchased 100,000 shares for $5.4 million recently. Management betting on themselves is a huge Lynch buy signal. Under this specific lens, Worthington looks highly attractive.
Now, for the toughest judge in the gauntlet, Section 4, the Benjamin Graham lens.
If we run Worthington through Graham's famous defensive investor checklist, it is quite a mixed bag. They easily pass the adequate size test with 9-month sales already crossing the $1 billion mark. They pass on earnings stability and their dividend record. But Graham is notoriously stingy on valuation multiples. He demands a PE ratio below 15 and a price-to-book ratio below 1.5. At a 26.17 PE and a high price-to-book due to their asset-light model, Worthington dramatically feels Graham's moderate valuation checks. To put a hard number on it, we use the famous Graham number formula for intrinsic value. It's the square root of 22.5 times earnings per share times book value per share. For our inputs, we use an EPS of $2.28. Because book value per share wasn't explicitly single-lined in our main data, we assumed it by taking their roughly $1 billion in total equity and dividing it by their 49.1 million outstanding shares. That gives us a book value per share of $20.39. Run the math, and Graham's intrinsic value calculation outputs a pretty grim $32.34. And that brings us to the harsh, localized verdict from the Graham perspective. Graham would absolutely not touch the stock. At a current price hovering near $60, it offers zero margin of safety against his calculated $32.34 intrinsic value. Graham doesn't pay a premium for future growth or intangible moats. He wants a severe discount to tangible book value. And Worthington's modern asset-light M&A strategy? It's the exact opposite of what this model rewards. Under this lens, it's a hard sell. Let's step away from the classic gurus for a minute. Section 5, DCF and alternative models. I'll walk you through this 4-step discounted cash flow process step by step so the math doesn't become overwhelming. First, we forecast their free cash flow. Their recent 9-month free cash flow was $115 million, so we annualize that to roughly $153 million as our baseline. Second, we project that out and calculate a terminal value, which is what the business is basically worth in perpetuity. Third, we discount all those future cash flows back to today's dollars. Finally, step 4, we divide by the share count to arrive at our fair value. Because predicting the future is, incredibly tricky, we use a sensitivity matrix. To fill the data gaps, we made a few standard assumptions. A weighted average cost of capital, or WACC, of 9%, representing a market average discount rate, and a terminal growth rate of 2.5%, matching long-term GDP growth. Assuming they can grow their robust free cash flows at about 10% in the near term thanks to their acquisitions, our DCF model generates a base case fair value range between $60 and $75 per share. That places the exact midpoint right around $65. And this brilliantly illustrates how alternative models view the stock. Let's look at comparable analysis for a second. Worthington's forecasted earnings growth of 24.22% actually outpaces the broader metal fabrication industry average of 21.51%. Because they are outperforming their peers in growth, Wall Street analysts have slapped a consensus 1-year price target of $69 on the stock. When you combine our DCF fair value of $65 with the analyst target of $69, the modern mathematical model suggests the stock still has room to run. Bringing it all together now. Section 6, Synthesis and Final Verdict. Take a look at this ultimate guru scorecard. Notice the massive divergence here. It's crazy. Asset-based, highly conservative models reject the stock entirely. Graham sees it worth only $32. Buffett acknowledges the quality and the moat, but demands a margin of safety, targeting 48. But the growth-oriented frameworks, they absolutely love what Worthington is doing. Peter Lynch's PEG analysis suggests it's fairly valued right now near 59, while modern DCF models and Wall Street analysts see fair value comfortably in the mid to high 60s. The main takeaway? Growth models love Worthington's high-margin M&A strategy. Traditional asset models absolutely hate it. Which brings us to our final, blended recommendation. Hold. At nearly $60 a share, the stock is fairly priced for the growth it's delivering, but it offers practically zero protection if the construction or consumer markets cool down. So I'm going to leave you with this final provocative thought. If Worthington hits a cyclical bump next year and the stock drops below Buffett's target at $48, do you have the conviction to step in and buy a great business, even when the strict math of Benjamin Graham still tells you no? Think about it. Thanks for joining me on this explainer, and keep learning.